Have you ever taken a trade that looked perfect? Clean structure, textbook entry, everything lined up, and still watched it hit your stop loss? It's one of the most frustrating feelings in trading. But the truth is, the problem usually isn't your strategy. It's one of 3 silent mistakes that turn winning setups into losing trades. Hello traders, and welcome back to the channel. In this video, we'll expose those 3 mistakes one by one and show you the exact process professional traders use to avoid them. Along the way, you'll learn how to read multiple timeframes, identify the higher timeframe bias, and align your entries with the market's real direction. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Before we name the 3 mistakes, let's watch 2 of them happen in real time. Here are 2 traders taking setups that look flawless and losing both. Watch closely, because you have probably made at least one of these yourself. Mistake number 1, trading a lower time frame trend while you are blind to the higher time frame. Let's start with a practical example. Here we have a clear uptrend on the euro against the dollar on the 5-minute chart. We apply the Fibonacci retracement tool from the start to the end of the recent impulse move, and we place a buy limit at the golden zone. The logic is simple. If price pulls back to this level, it is a deep enough retracement for us to enter the market and take advantage of the uptrend. However, price suddenly drops, and we end up losing the trade. To understand why, we zoom out to the 1-hour chart and realize that even though the lower time frame showed a bullish move, the overall trend on the higher time frame was actually bearish. What looked like an uptrend on the 5-minute chart was simply a corrective move within a larger downtrend. Once price resumed its higher time frame direction, it led directly to our loss. That takes us straight into mistake number 2, ignoring the higher time frame key levels. In another example, we see a clear downtrend on the 1-hour chart. A fair value gap above a liquidity zone appears to offer a strong shorting opportunity, so we prepare the trade. At first, price reacts slightly in our favor, but it eventually reaches our stop loss again, leaving us wondering what went wrong. By zooming out to the daily chart, we noticed that price had just reached a significant support zone, and we entered a sell position right after that. This means we were trading against a potential higher time frame reversal, which likely caused the setup to fail. 2 perfect-looking setups, 2 losses, and both came down to the same blind spot, the higher time frame. So how can we avoid this kind of mistake? You might assume the answer is to analyze more timeframes, and that is exactly where the 3rd mistake hides. It does not require starting from the monthly time frame and analyzing all the way down to the 5-minute chart. In fact, using more than 3 timeframes usually adds unnecessary noise. Anything beyond that is either too broad or too detailed to provide meaningful context. There are 3 types of timeframes we work with. First, we have the main timeframe, where most of our analysis takes place. This includes identifying market direction and structure, spotting liquidity zones and imbalances, and marking the trading zone. If confirmation is needed and we are not fully confident in taking the trade, we can then zoom into a lower timeframe to look for additional signals. For example, if we have marked a demand zone on the 1-hour chart but want extra validation, we can switch to the 5-minute chart to see how price reacts to that zone. Price action signals such as long wick rejections or a double bottom pattern can serve as strong confirmation that the zone is being respected. These lower timeframe clues can give us more confidence to take a long entry. At the same time, it is also important to check the higher time frame to get a clearer view of the bigger picture and make sure our analysis aligns with the overall market direction. For example, an ideal trading scenario is when both the higher and lower time frames are showing an uptrend. Another strong setup is when a market structure shift on the lower time frame happens right at a key zone identified on the higher time frame. This brings us to the heart of today's video, which is how to analyze the higher time frame to determine the daily bias. But before that, why do we even need to determine the daily bias? And why does the higher time frame matter? These next three reasons are exactly why the mistakes we just saw are so expensive. The first reason is that higher time frame levels are more important. A minor reaction at a key level on the higher time frame can lead to a significant trend change on the lower time frames. That is why, before placing any trade, we should always check how much room price has before reaching a higher time frame supply or demand zone. This helps us set more accurate targets and stop losses, and it also helps us avoid entering trades that are more likely to fail. For example, here on the US dollar against the Japanese yen 1-hour chart, we can see a strong uptrend. At first glance, it looks like a promising bullish market for entering a long trade. However, price fails to create a new higher high and rejects the same level twice before reversing. Now, if we zoom out to the daily time frame, we can clearly see that this area has recently acted as a strong support and resistance level. So, despite the strong bullish momentum on the 1-hour chart, the market still reversed. This shows why higher time frame key levels are more important. They give us a stronger indication of where major reactions are likely to happen, because they reflect longer-term trends and more stable areas of interest. The second reason is identifying the macro trend. The best trading setups appear when the higher time frame and lower time frame are aligned. Imagine entering a trade on the 15-minute chart just because you see a bearish structure forming. But without checking the higher time frame, you miss the fact that this downtrend may simply be a corrective move inside a larger bullish trend. In that case, price can reverse at any moment and continue in the broader bullish direction. On the other hand, when the lower time frame setup aligns with the higher time frame trend, you are trading with the overall momentum. That greatly increases the probability of success because you are no longer fighting the dominant direction of the market. The third reason is filtering noise and fake breakouts. Lower timeframes often contain a lot of market noise, unpredictable price swings, and false breakouts that can easily trap traders in bad positions. By identifying the higher timeframe bias first, we gain more clarity on the dominant market direction. That helps us filter out setups that go against the broader trend and avoid getting caught in fake breakouts that happen during short-term corrections or consolidation phases. For example, on a 5-minute chart, you might see what looks like a breakout below a recent low. But if the higher timeframe trend is bullish, that breakout may simply be a liquidity grab before price reverses back to the upside. Without the higher timeframe perspective, that can easily lead to unnecessary losses. Now that you understand why higher timeframes are so important, let me show you how to find the higher timeframe bias on a chart and explain, step by step, which concepts we use. This is a general trading plan that uses multiple timeframes based on the main ones most traders focus on when analyzing charts. However, some traders make the mistake of starting from the monthly chart and going all the way down to the 1-minute chart, thinking it will lead to a perfect trade. In reality, this often creates confusion. The chart becomes filled with too much information and noise, making it harder to make clear decisions. That is why it is better to use a maximum of 3 timeframes. For example, if your main analysis is on the 1-hour chart, you can use the 4-hour and daily charts to support your setup. More importantly, higher timeframes should only be used for simple concepts, such as marking key levels and identifying the overall market direction. There is no need to analyze every single timeframe. Using too many charts can lead to mixed signals and unnecessary complexity. Keeping just 2 higher timeframes above your main one is usually enough to get a clear view without overcomplicating the process. So in this part of the video, let's go through some real chart examples to show how we combine multiple timeframes, from identifying the higher timeframe bias to finding confirmation and executing the trade. For this analysis, we will use the 1-hour chart as the main timeframe, the 4-hour and daily charts as higher timeframes, and the 5-minute chart for confirmation and entry if needed. Now let's put it all together and watch what it looks like when none of these 3 mistakes are present. So here we have euro against the dollar on the 1-hour chart. The structure is clearly bullish, with price consistently breaking above previous highs, which is exactly what we want to see. If the market looks unclear or choppy, it is better to switch to another pair, or simply step away and wait for a better setup. There is no need to trade every day, and taking more trades does not necessarily mean making more profit. Since the 1-hour chart suggests an uptrend, we are only interested in buying this pair. However, we cannot enter the market immediately because price has moved up quickly and may correct at any moment. Because of that, we need to wait for a pullback to enter at a better price. Now the question becomes, Where is the optimal entry zone? To answer that, let me show you how professional traders define optimal entries. OTE stands for Optimal Trade Entry. It refers to a specific Fibonacci retracement zone that aligns with discount for long trade entries and with premium for short trade entries. The idea behind OTE is to refine entry timing by focusing on areas where price is considered optimally priced within a range. It is important to note that ICT's original teachings define the OTE using the 0.62, 0.705, and 0.79 retracement levels. However, at ComLucro, we prefer to use the traditional Fibonacci retracement levels of 0.618 and 0.786, while still recognizing the importance of the 0.702 midpoint. We believe that using the classical Fibonacci levels increases confluence, since these levels are widely followed by traders across different methodologies and markets. Before applying the OTE, it is important to correctly configure the Fibonacci retracement tool. In a bullish scenario, the 0 level should be placed at the swing high and the 1 level at the swing low. In a bearish scenario, the 0 level should be placed at the swing low and the 1 level at the swing high. Regardless of how the Fibonacci is drawn, the premium zone will always be located in the upper half of the range, while the discount zone will always be located in the lower half. The position of the Fibonacci levels may change, but the concepts of premium and discount remain the same. Now that you understand how to define the optimal entry zone, let's apply that directly to our current setup. If we focus on the most recent impulse, we can see that it has created a fair value gap. From there, we mark manually on the chart the candle that initiated this move as our order block zone, since there is a higher probability of a reaction if price returns to this area. At the same time, this area aligns with the OTE zone, which gives us a clear confluence for a potential entry. With this in place, the plan is simple. We wait for price to pull back into this zone and look for long opportunities. Once price reaches our trading zone, the next step is to check the higher time frame and see if our analysis aligns with the bigger picture. So let's switch to the 4-hour chart. We want to keep things simple, so on the higher time frame, we focus only on identifying the overall direction and the key structure levels. Here, we can see that price was previously in a long-term downtrend, but that condition has now changed. Price has broken above previous trend lines and key supply levels, showing strong bullish momentum. In other words, the 4-hour chart is also confirming a bullish market and an ongoing uptrend. Now, let's mark manually on the chart the key zones where price has recently reacted near the current level. We can identify 2 important areas that have acted as both support and resistance multiple times. Above that, we can also see a strong level that has rejected price twice and acted as a major turning point for the 4-hour structure. This makes it a very significant zone, and price is likely to react again when it reaches that area. This means that if we take a long position, our higher timeframe target would be that upper resistance zone. For now, there is still enough room for price to move before reaching it. With all of this in mind, the higher timeframe analysis aligns perfectly with what we saw on the lower timeframe. So let's switch back to the 1-hour chart. Since the higher timeframe confirms a bullish trend, it makes sense to consider a buy position at the order block, with the stop loss placed just below it. However, we can refine the entry further by moving down to a lower time frame and looking for a reaction at the order block. First, wait for price to approach the zone, then switch to the 5-minute chart. At this stage, the only thing we need to see is a clear reaction from that area. This could be a simple long wick rejection, which is enough to confirm interest. In that case, we enter the trade at the close of the rejection candle and place the stop loss below the wick. At the same time, we avoid placing the stop loss too tight. The idea is to give the trade enough room to move and avoid getting stopped out by normal market fluctuations. By combining multiple timeframes, we align the overall trend with a precise entry point, increasing the probability of success and improving confidence in the setup. One last example, just to lock this in, and notice how it circles right back to mistake number 2. Now let's go through another example on the pound against the dollar on the 1-hour chart. Here we can clearly see a downtrend. The most recent impulse has created an imbalance and also formed equal highs, which means liquidity has built up above that level. From there, we can mark manually on the chart the small consolidation before the imbalance as a supply zone. As traders, we understand that if price retraces above the equal highs, takes the buy-side liquidity, and reaches the supply zone, it can create a strong short opportunity. Based on that idea, we can place a sell limit at the zone and position the stop loss above it. But before executing the trade, we need to check the higher time frame and understand the broader context. Looking at the 4-hour chart, we can see that price has just tapped into a strong support area. This level has acted as a turning point multiple times, and the reactions from this zone have been strong. All of these factors confirm that this is a key higher time frame level. So now that price is testing this area again, there is a higher probability of a rejection to the upside. This means the market has the potential to move higher, even though the 1-hour chart is showing bearish pressure. If we go back to the 1-hour chart, we can see that taking the short setup in this context would be risky. And if we play price forward, we can see how strongly price reacted from the higher time frame level, pushing above our stop loss and eventually reversing. This is a clear example of why we should always check higher time frame zones before entering a trade based only on a lower time frame setup. Avoid these 3 mistakes and you stop taking trades that look perfect but go against the bigger market move. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Com Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Com Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.